All right, good morning. Welcome back to the Money Advantage podcast. Bruce, we are really excited to be having this conversation today about really how to spot the mistakes that people make with infinite banking. And by mistakes, what I mean is that there is a way that infinite banking was originally designed by its creator, by Nelson Nash, who came up with the infinite banking concept. And we would call that the original intent or the original design for infinite banking. And as this concept has gained popularity and traction with so many people becoming interested in the idea of becoming their own banker and storing capital that they can access and be able to use through a specially designed whole life insurance policy. We've seen these new messages kind of cropping up all around in the woodwork, and really from this place of sometimes not understanding the original intent or trying to improve upon the original design or trying to make it more attractive or trying to say it in a way that is more attention grabbing. And some of these messages have gained traction and have taken a lot of people down a path of thinking that they can do better infinite banking than the original infinite banking. Now, we've talked about these things quite a bit of times on the podcast, but we wanted to put this all together in one episode for you that really is this idea of how can you spot these red flags in the area of infinite banking so you don't make mistakes. So instead of making mistakes, you can actually begin to make traction with the infinite banking concept, and you can set yourself up for a lifetime of long-term financial success and stability for yourself personally and for generations to come. So that's our goal today on this podcast. And Bruce, we're going to try to keep this episode pretty compact for you today, but I would love your thoughts as we jump in, and then we're going to cover 9 infinite banking mistakes that we see really rising to the surface as the most common mistakes that are made in this area.
Yeah, it was you know, sometimes you can't see the forest for the trees, my dad used to always say. And just recently, after we decided we were going to do this episode, I read a quote by somebody, I think it was on LinkedIn. It said, "Be careful who you are listening to online because you may start believing them."
Mm.
And I think that is the difficulty for people is we have a confirmation bias where we're actually searching for things that we already believe in, but you don't even know where your beliefs come from sometimes. And so you have to actually be self-aware enough to really look at every aspect that you're listening to online and ask yourself, why do I believe that same thing that that person believes? And you and I have talked about this before. I mean, we hope our listeners say the same thing about what we're saying, because that brings in true transparency, and it also brings in an educated listener. But we have short attention spans, so TikTok and Instagram. Now, YouTube has shorts, Facebook has shorts, all these have shorts. And we do want this concept to be simple because that's what Nelson really tried to get across, that this is simply replacing the banking function with one financial institution that we commonly call a bank, with the banking function with another institution that is an insurance company. Now, the insurance company is not a traditional bank, but you can do the banking process. And this is where people get confused. And so we're going to try today the things that have come up over our career on this, we're going to try to simplify this. So I think this is going to be a very valuable episode for people.
Absolutely. So let's jump in. The first problem that we see, or the mistake that we see people making with infinite banking, is comparing illustrations. I'm just going to give a snapshot of what this means, and then Bruce, we're going to just kind of unpack a little bit about what you can do about this. So the problem with comparing illustrations comes from this idea of wanting to be able to make a good choice. And if you're wanting to make the right choice, you are trying to make sure that you're evaluating the options according to whatever mechanism you think is the best method to compare options. The problem with comparing illustrations, though, when you look side by side, you see all of the data and numbers for the projections, the expectations for policy A versus policy B, and you look at what is the cash value in year 20 and what is the dividend rate, and is it why am I forgetting the word? Non-direct versus direct recognition company, and what is the death benefit? When we look at those types of things and we get an idea of what we think is going to happen with these two policies over time, we have to remember that those are snapshots in time. An illustration is not a guarantee of future performance. It is a projection based on today's dividend rate and today's interest rate when you begin a policy. And we need to recognize that the dividend is not guaranteed, and you cannot have a projection of future performance be the thing that you're making decisions on. And you can't get bogged down in what you think the technical numbers are, because year 20 is going to look different in reality than what the illustration shows. And that doesn't mean the illustrations are false. What it means is that you have actual life circumstances that are going to change your reality. What I mean is that you have guarantees on both illustrations. Those guarantees will never be your actual reality because dividends are going to be added. But dividends are projected at today's rates for each of those companies or each of those policy designs. And in reality, if the market or the economic environment causes dividends to rise or fall, you're going to have changes in that performance when you project out into future years. So Bruce, that's all I want to share on the problem. What do you see as the main problem really with comparing illustrations?
Well, I would say that let's start with the main premise about this is that Nelson said that you're always going to be storing money in the bank. So capital has to lay somewhere. So instead of have it lay in the bank where you get little rates of return, and even if you do get a greater rate of return, you have greater borrowing cost. So it has to lay somewhere. So the rate of return, Nelson said all the time, is not important because money has to lay somewhere. And we've done an episode on rates of return, but I see people are always constantly trying to, like you said, not make a mistake. So they're comparing one to another. And even when a person understands this concept, we've had a client before, I think it was 6 or 7 years ago. I remember him saying this. He goes, Bruce, I believe everything you're saying. He goes, I believe that rates of return are important. I believe that illustrations are simply a snapshot in time and they're going to change. However, when I compare this company to this other company, at the end of 30 years, this one shows I'm going to have 20,000 more dollars. And I don't want to take the chance that I'm wrong. So I want to go with this company. Now, saying that, he is taking a chance that he's wrong because that particular company now has actually changed their dividend rate compared to the other one that he was comparing it to. So he's going to be wrong. But that is the main thing that I see people all the time is they're comparing illustrations because they're afraid of making a mistake. To get rid of that scarcity mindset, I think you ought to just say to yourself, hey, this is money I was going to put in a bank and get a very little rate of return with anyway. So that's really the mindset you have to have. And that's the mindset Nelson was trying to talk about because he said rates of return do not matter. It's about storage.
Absolutely. And so, Bruce, what you're saying through that is that comparing illustrations, the underlying thing that somebody's doing is looking at rates of return. They're pegging their decision on what a projected rate of return is. And you're saying the solution is that we need to understand the concept. The concept is you're storing capital. You're being able to borrow against that capital. You're having uninterrupted compound growth. You have a death benefit attached. In addition, you are reclaiming the banking function because now you don't have to go pay interest to outside institutions. You're earning interest and dividends within this whole business that you have created by placing your policy inside of a life insurance, or by placing your dollars inside of a life insurance contract. And you're building up cash value you can use now. So let's look at mistake number 2. That is not planning ahead to pay premium. Bruce, I would be curious to see how often this comes up, because normally we're dealing with people who are already having good money habits and making good financial decisions. But I think the challenge could be getting really gung ho about this idea of infinite banking, using the infinite banking concept, and getting maybe a little overzealous to put a lot of premium dollars in a current year and not thinking about where is that cash flow going to come from in future years, or letting life get in the way and spending the dollars that you had intended to put aside for paying your premium. And the other challenge is you don't want to be in a position where you're nervous about paying your premiums when that time arises, when the bill comes that you're now supposed to pay your premium dollars into your policy for the coming year, because you want to have a system in place that you've already set aside those dollars and you're prepared for making that transaction.
Yeah, so the problem is that people are nervous about paying premiums because they think, oh, can I continue to do this? And they have no system to determine that. And this happens to us all the time. We have people coming in from other organizations that say, I don't understand this. Can you please help me? So we see this all the time. The number one thing I tell people all the time is you have to understand their full financial picture and their full cash flow. And cash flow is what's coming in compared to what's going out. It's like a profit and loss statement for you personally. So you have to be willing, number one, to give enough information to a authorized practitioner to actually be able to walk you through this. And then two, you also need to understand the policy design can actually help you ease your nervousness, because number one, the bare minimum that you need to be able to pay is the base premium. But the base premium should not be the only thing that you worry about. You should try to get as much of your capital into this as possible. But that's where people get nervous. What if I can't do it? Well, there are safeguards for you. You can only pay the base and the term to keep it from mecking. And then most companies have a very minimal PUA to keep the PUA rider open. And when I say minimal, it's under $500. And then you must actually understand that you can actually pay with values. We don't have enough time in this podcast to explain that. But basically, as you're building up the policy, you're increasing the values of the death benefits. You can actually relinquish some of that death benefit, and they will credit you some of the premium if for whatever reason life gets in the way. And so you could actually reduce the death benefit by a little, and they'll credit you the premium. You can have the dividends paid. You can have some of the cash value pay. So there's a lot of flexibility if you understand all the aspects of a specially designed whole life insurance contract.
Absolutely. So, Bruce, that actually plays into the third problem. So, second problem was not planning ahead to pay for premium. The solution for that is making sure that you, as the policy owner, are in a position of having your spending plan in place, watching your cash flows, setting those dollars aside in advance to pay your premiums. And then the third mistake people make is having to guarantee the future before you start. And I think sometimes what happens is that somebody says, well, look, I can't guarantee that over the next 30 years, I'm going to be able to put in this many dollars into a policy. I have no idea what's going to happen in 30 years. What is my income situation going to be? What expenses might I have arise in that environment that I'm unaware of today? And how can I possibly lock myself into a commitment for coming years in the future? And so the answer to that is knowing that you have options to be able to do all of those things that Bruce, you just mentioned: paying from policy values, using dividends to pay premium, and using policy loans to pay premium. You have a lot of options within a properly designed life insurance contract to be able to have flexibility when challenging economic situations arise in your life and you now are confronting a premium payment that is impending, it's due, and you're not having the cash flow to be able to handle that. So two sides of the same thing. One, you need to plan ahead. Don't make the mistake of not planning ahead to pay premiums. But secondly, don't make the mistake of getting stuck or preventing yourself from getting started with an infinite banking policy when you are not able to guarantee the future.
Boy, Rob on YouTube made a really good point. He said paying premiums and BYOB is all about personal discipline. Right to pay and have to pay is helpful too. Rob,
Versus,
this
yeah,
is
right to pay.
yeah,
That's awesome.
yeah, that's a really good point. And Nelson used to always say this is why he didn't really worry about illustrations at all. Matter of fact, Nelson said to me and many practitioners, he wished he would have never put illustrations in the book. And it's also the part that people don't understand about his book because Nelson says your behavior is more important than policy design or the company that you're working with. And that's what Rob's just saying. And if you
I like,
understand, yeah,
go ahead,
go ahead.
Bruce. I was
And
just
if
gonna
you
say, I
understand,
love that. Sorry, you go ahead, Bruce.
if you understand that cash is always has to lay somewhere, even if you reduce the amount of cash coming in. But then Dan Sullivan, one of my mentors, he says that let's look back to see what the future might look like. And so if you look back on what your cash flow was 10 or 20 years ago and compare it to what it is today, most everybody will have an extreme increase in cash flow. So now when you're going forward, you can say, oh, well, 20 years from now, I'm going to make 10 or 20 times more than what my current cash flow is. So I'm going to easily be able to make that premium payment.
Absolutely. I just wanted to capitalize on that idea again here, right to pay versus have to pay. The idea, and Rob, thank you for that terminology or those words, the language to put around this idea. But if you have set up a specially designed life insurance contract, that means that you now have the right to pay premiums into this banking system. You have the ability, you have the provision to be able to put money aside. You have a contractual ability to that allows you to put in premium dollars, and then the life insurance company is going to fulfill their end of the contract. It's that unilateral contract. You have locked in that ability to pay those premiums. So if you think of it as, oh, I have to pay these premium dollars, it's an obligation, it's a requirement, it's a thing I'm forced to do, that's not an empowering way of thinking. It is much more empowering to think about how it's a right and an opportunity to be able to pay that premium. And I can guarantee you that every time Lucas, my husband, and I get ready to pay our premiums, we're really excited because we see that increase in cash value as a result of paying those premium dollars. And it's very exciting as a right to pay premium. So thank you, Rob. All right, let's jump into the next mistake that people make around infinite banking. And I am going to say this like it is. This is mistake number 4. This is using a non-whole life policy. The reason we included this idea in this list of mistakes about infinite banking is that people try or think that they could do better than a whole life insurance policy by using an IUL or using a universal life or a variable life or a VUL type of policy that might somehow perform differently or better than a whole life policy. And what I want to say very clearly is that we labeled it as a mistake of infinite banking, but it's really not infinite banking. If you use a policy like that, you cannot call it infinite banking. And the reason is that in order to have an infinite banking policy, you need to be able to have a few guarantees. You need to be able to have the guarantee that if you pay premium dollars, the insurance company will fulfill their obligation to have a minimum cash value amount and a minimum death benefit amount as listed in the contract. What that means is you have guaranteed premium, guaranteed cash value, guaranteed death benefit. You do not have those guarantees within other policy designs, which is why you cannot rely on them for infinite banking. Bruce, I know you have a whole lot more to say on that.
Yeah, and I could go on for days about this, but the first thing I want to talk about is, infinite banking is a process. It's not a policy that you get from a company. So all the insurance companies are very sensitive about this. So occasionally, both Rachel and I both we get a little uh, uh, lax in our words, and we say infinite banking policy, but it's actually the infinite banking process utilizing a whole life insurance contract. And the reason it has to be a whole life insurance contract, as not only did Nelson say in his book not to use universal life, but if you know anything about how any of the universal life policies come, um, they say they have guarantees, but what they mean by that is they have guarantees as long as you can pay an increased premium, where whole life does not have any increased premiums. And why is that? It's because whole life is an actuarial product to age 121. So it endows at that time. So the actuaries actually can accurately produce, where universal life will not do that. And you cannot reduce pay up. You can reduce the policy, but you cannot reduce pay up. So just like a bank has guarantees, you need, if you're going to do the banking process with another financial institution, you need to have guarantees. And then the final thing that I'll say, and I've said this on other podcasts, if you don't understand the difference, you don't even really need to know the details. All you have to do is take an illustration from any universal life policy and compare it to the illustration of a whole life policy. The universal life policy will be at least twice as thick as the universal life contract and the illustration. Why? Because the universal life
Disclaimers,
is
nuances.
yes, they're telling you why all this probably won't work. And so that's why you need to stay away from that.
Absolutely. So I'm going to jump into, Bruce, I changed the order a little bit because I think this is going to make more sense here. So we're going to say number 5 on the list of infinite banking mistakes, or top infinite banking mistakes, is focusing only on cash value. Now we have a lot to say here, so I'm going to pack it in the shortest, most concrete terms that I can give you. And then I want to be able to unpack this a little bit with you, Bruce. So there can be a temptation as soon as you have the idea of infinite banking in your mind, that the most important thing to focus on could then become the first day's cash value amount. And the reason this can be a temptation is that you say, well, if I'm going to store my capital somewhere, I want to be able to access that capital. Why would I only want to be able to access 1% of my capital if I could access 100% of the capital that I've stored away in this storage tank called the infinite banking process, or the infinite banking concept that we're using a whole life insurance policy for? So what can then that thinking leads itself to, or lends itself to, designing a policy with more paid up additions and less base premium. What happens in that case? Base premium gives you more death benefit. Cash value, or PUAs, give you more cash value. If your attention and focus and priority is on saying, how do I get the fastest early cash value? The way to do that is to have as much paid up additions as possible. You could almost say, if that's all you wanted to do and the death benefit really wasn't that important, well, why not just design a policy that's all paid up additions and has no base premium? That's not possible, right, with a life insurance company, but that would be the thinking. The thinking would say, let's veer towards having so much paid up additions that we kind of overlook this base policy at all. And that thinking has led to the attractiveness of what we call 1090 policy design, which is 10% base premium, 90% PUAs, for the purpose of having that maximum early cash value. Now, the number one problem with this kind of thinking is that it ignores the long term. It ignores the benefit and the value of the death benefit. It ignores policy design and the ability to maintain your tax advantages and not bump over into a MEC contract. And it also ignores the fact that the death benefit is extremely valuable to you and to your heirs. That's where I'm going to leave that idea. I'm trying to wrap that in the tightest package possible. Bruce, I would love you to just share as much as you'd like about that idea.
Yeah, so whenever you decide to put your money anywhere, you have to think about safety, liquidity, and growth. You can't get all three. And so I'm going to review this real quickly. Think about the bank. Is it safe? Relatively, yes. Is it liquid? Yes. Does it grow? No. Let's think about a piece of real estate. Is it safe? 2008 proved it was not safe. Is it liquid? No, you actually have to ask the bank for permission to give your equity back to you. Does it grow? Well, traditionally it does grow. Stocks, safe? No. Liquid? Yes, you can buy and sell it on the same day. Does it grow? Traditionally it grows. So then if you don't get safety, if you don't get one of those, you have to get a premium for that. And generally what people think is, if I don't get safety, I want to get more growth. Okay. If I don't get growth, I want to get more safety. If I don't get liquidity, what do I want to get for that? Well, you got to get a premium for something. In general, in the investment world, if you don't have liquidity, there's something called a lack liquidity premium. I'm going to get more for that in the form of a distribution. In a life insurance policy, if you don't get liquidity, what do you get for that? Number one, you might get a death benefit. Number two, you might get chronic illness rider. Number three, you're going to get some guarantees. Why are you going to get guarantees for lack of liquidity? Because the life insurance company knows they're going to have that money for a long period of time. And you're going to get tax free. Why are you going to get tax free? Because the United States Congress put into the tax code an incentive for people to buy life insurance. Okay, so all of those things you have to take in consideration. And the number one thing I see when people want to do these skinny base designs is they have been taught by somebody. Like I said at the very beginning, be careful who you are listening to because you might believe them. They are convincing you to do work with them because we are designing policies so that we make lower commissions. And that's got to be great for you. Well, the fact of the matter is that is somewhat true. But the second thing is just because it's great for you in one aspect in the form of a lower commission doesn't mean it doesn't bring in other things. And you already mentioned that. The biggest one is you bring in uncertainty. And the uncertainty is about future growth. Didn't I just say if you get lack of liquidity, then you should expect future growth? Well, if you get a lot of liquidity, you're likely not to get as much future growth. The other thing about lack of liquidity, or excuse me, when you have a lot of liquidity early, is yeah, you can have a lot of money to actually utilize and borrow against. However, for the same reason that that you get a lot of liquidity is because it's optional. And the life insurance companies do not know if you're going to pay it next year or not. So they cannot put it into a long-term investment because they have to keep liquidity if you want to loan against it. Well, if you have liquidity, you don't have as much growth. It's that easy to understand, but people just are blinded by these marketing ideas. And so whenever you're looking at this, if you just go back to Nelson's 5 tenets, the first two are think long term and don't be afraid to capitalize.
I want to say a couple more things about this whole idea on the 1090 because I was working to unpack some of these ideas in my own mind this week to be able to communicate them most effectively. And bringing in the idea of not thinking long range, a 1090 policy is looking not just with blinders to the opportunities beside you, but really looking very short-sightedly in front of you, just to that first early cash value. And you're not looking past that first early cash value to what the policy is going to perform like in the future. And you really do need to think long-term. A few things that happen when you have the highest PUA possible, the 90% PUA policy design and only 10% base. What happens is it's unstable policy design because your base premium gives you more death benefit. The death benefit is required to be high enough in relation to your cash value. There has to be a gap, a corridor big enough between your death benefit or between your cash value and your death benefit in order to not mech the policy. When you have your cash value be so high compared to your death benefit, you're more at a risk of meching the policy early, which then means you lose out on the tax benefits of having your initial design as you intended. Another thing that happens is in order to get your death benefit, so if your cash value is super high at the beginning, you have to bump the death benefit higher, the way you do that is by a term rider. And often that term rider that is used in that case, not always, but often that's annually renewable term, meaning the cost of that particular term rider inside the policy can increase each year. And then how do you pay that term rider? You can have your dividend, which is not guaranteed, can be required to pay for the term rider before it can be used to pay your paid up additions, if that's the way you've set up your dividends to have your dividend purchase more PUAs. If it's being used up on this term rider cost, you don't have as much to purchase the PUAs you had intended. And if that dividend is not sufficient to pay that higher term cost in the future, then you might have to come out of pocket to be able to continue to pay those term costs inside of the policy. All of that is to say that you can have things be less guaranteed and less stable. You can actually end up turning the policy to have more risk, like, and I'm not saying it is, but like an IUL type of policy where there could have factors requiring you to pay additional premium to keep that type of structure in place to maintain your tax benefit. In addition, you often have your dividend growth is higher on your base premium than it is on your paid up addition premium or your paid up addition cash value. And what's happening with that is you want the higher growth in the future so that you can have your policy perform best for the long range, not just for that short-term, short-sighted view right in front of you. The last thing I do want to mention on this whole idea is that when you design a 1090 type of policy, it often limits the number of years that you can put premium into the contract. Well, if you're saying, I don't know what the future entails, and maybe I wouldn't be able to pay my premium in those years out in the future, maybe I like the idea of not being able to put as much premium into a contract. That is breaking the rules of infinite banking. You're not thinking long range in that position. Then you want to, with infinite banking, as you're putting dollars into this policy, you want to be able to put as much premium in as long as possible so that you can capitalize as much as possible into the future and have the greatest advantages of this policy working for you. So really the solution to this short-term thinking on just first initial cash value being as high as possible, the solution to that is to have your adequate base premium, have a high death benefit growth, have higher dividend distribution, have longer ability to make premium payments, and have the ability for it to not mech.
Great summary.
Okay, Bruce, let's move into the next one, which is 1, 2, 3, 4, 5. I think we're on number 6. This is the 6th biggest mistake we see with infinite banking, and this is using it to pay off debt. Let me explain. There is this concept called velocity banking, in which you start a policy right now, you build up the cash value inside the policy, you use it to pay off debt, then as you're paying off debt, you're rolling that into your policy, you have a policy loan instead of the debts on the side, and you're shuffling money back and forth is really what's happening within velocity banking. The problem here is that if you're using infinite banking as a tool to get out of debt, if that's your challenge right now, you have a lot of debt, you have debt fixed payments going towards debt, you don't have a lot of free cash flow income greater than expenses to put into a policy. If you are starting there and you're saying, well, I want to get started with infinite banking, it sounds like a really attractive concept, you're expecting infinite banking to be a rescue plan to fix bad habits. And really what you want to do, the solution is to first attend to and prioritize the proper strategy for paying off debt, and then getting in a position where you're getting as much cash flow from paying off those debts as possible, and then be able to start an infinite banking policy. Bruce, I'd love to have your thoughts around that, and we can dig into as much as we want to on this as well.
Yeah, I think when you're really, over my career, I can count on less than one hand where this has actually worked for a person. I mean, I don't know what else to tell people except for experience. You actually have to change your mindset. So now the way I do it is if a person comes to me and says, I think this is a great idea, it's going to help me get out of debt, I say, no, let's get out of debt first, and then let's use the increased cash flow to start a policy. I am not saying it can't work. So there are some people that get into a debt that is kind of a one-time thing, where a child fell into some financial difficulty, so they bailed them out. So they took on a loan that they to help the child, or they had a medical expense that they didn't expect, and so in that case they have the cash flow. Um, a really good indicator is what I found is if a person has some unsecured loans and the minimum payment is $100, but they're paying five, six, seven, $1,000 a month on it. Well, then that's a good indication that they have the additional cash flow that we could now utilize that to start a policy and then borrow against the policy to pay off the debt in an efficient way. But Rachel, you hit it on the head. What I've found over my career is people that are trapped into the mindset of debt, we have to break them of that mindset first before we can actually implement a contract uh, to mimic the banking function.
I do want to say one more thing on that before we leave this idea, and that is we use something called the cash flow index. If you are in a position where you have debt in so many places that you're very overwhelmed by it, I want you to know that there is a solution to paying off that debt, and it is not to tackle all of it at once. It is not to throw all of your extra dollars into paying off loans. It is not to address the high interest loans first. None of those are valuable strategies that will actually move you forward. We have a tool called the cash flow index that helps you measure every single loan or liability payment that you have with the minimum payment and the balance. And it's a calculation that allows you to see the value of paying off that particular loan in terms of which one frees up the most cash flow. And if you use this tool, you will more quickly be able to address the loans that will free up the most cash flow, which then give you a additional leverage because you have more cash flow to be able to tackle and address the next loan. Just know that it's more valuable for you to continue to make minimum payments on something while you're storing up cash on the side that you control, that you can access for any circumstance, whether to all at once pay off a loan, or whether to use for an emergency, or whether to store up as an opportunity fund. It is more valuable for you to do that than to throw extra $2,000, $3,000 at random debts trying to pay them off as quickly as possible, because being debt free does not mean you're financially free. So that's what I'll leave that piece there. Bruce, we're on number 7. The 7th mistake we see people making with infinite banking is using up all accessible cash value. What do I mean by that? I mean somebody who says, I have $100,000 of cash value. I'm going to take a $100,000 policy loan right now, and I'm going to redline my policy. I'm going to continue to maintain maximum loans in this policy by taking out as much as I can all the time and maintaining a position where I am having a maximum loan or lien against that cash value. The reason why this is challenging or why it is a problem is that if you're taking maximum loans just to get by without a plan to repay, you can get yourself in a really bad position where you don't have the cash flow to make policy loan repayments, and you can get into a strain because you've used up all of your ability to access capital. What do I mean by that? If you have $100,000, so let's say you have $500,000 of cash value, that is a really nice position where you say, I have an emergency fund, I have an opportunity fund, I have cash I can lean on and access, whether I lost a source of income, whether I want to purchase a rental property, whether I want to buy out another business. You have cash available, and that value of liquidity is very, very, it's at a premium, I guess, it's very, very premium. It's amazing to have that capital sitting accessible and ready for you. As soon as you take that maximum loan, you have utilized that opportunity, but you no longer have that opportunity that exists for another opportunity. So don't think of your cash value as something you always want to take a maximum loan against. Bruce, what are your thoughts around this one?
Yeah, I mean, I think you summarized that very, very well. I've seen this mostly in the real estate developer world, and more recently in what we call the SPAC, special acquisition companies, private equity. They're always trying to get their money in motion, money in motion, money in motion. And that's great in a low interest rate environment. But now that we're in a higher interest rate environment, the lack of liquidity is really hurting the real estate world, the investment world, so on and so forth. And so that is why having capital for those opportunities that may arise, or just simply having capital for the downturns or the emergencies that you come up, is a really nice feeling so that you can actually perform your best in other aspects of your life. And so people discount that all the time. And once again, they get this from online. You got to get your money in motion. You got to get your money in motion. That's how you make money. I just looked up the other day what people consider the greatest investor in the world, Warren Buffett. Berkshire Hathaway is sitting on $357 billion in cash.
Which
So,
means it's not in motion.
right, it's not in motion. Yeah.
So the solution to this mistake of using up all your accessible cash value is to recognize that policy loans are good. The idea of infinite banking does say if you have cash value available, it is available to be utilized, and you can continue growing that capital inside your policy and putting it to work in another investment or another opportunity at the same time, and you're earning two returns on that same money. But using that with moderation, recognizing that you're balancing that utilization along with the value of having capital sitting that's not in motion, so you have the opportunity to access it if the need arises. So balancing that ability to access capital in the future with the access of capital now. All right, Bruce, number 8, we're coming in for a landing here. So the 8th mistake we see with infinite banking is viewing it as a one-time event. And this really relates closely to the idea of having a short range thinking, or being almost narrow-minded and thinking that it's just about the now versus the future. When you start a journey of any kind, it is amazing what kind of opportunities arise after you've taken step 1 that never would have been available or evident to you had you not taken step 1. And you get more opportunity, you have more ability to think clearly and more ability to make better decisions the further you continue along a good path. So if you are looking at infinite banking as one policy only, this is my start to infinite banking, I'm starting my policy. This is short-term thinking, because the problem is that you can't get infinite banking to work from minimal effort. It's not a one-time infusion of capital. It's not a one policy. It's not a before infinite banking moment, and after infinite banking with that one time event thinking. Really, the solution is to recognize it's an ongoing process. It takes a lot of commitment. It is a long game. It is something that you are opening up the opportunity to have additional policies, a whole system of policies, a family that can participate in borrowing against the capital and the cash value using family banking, paying a policy into future generations and using it as a generational wealth generator or engine in your family. There's so much that you can think about with infinite banking if you are willing to envision and view it as a process, not an event.
Yeah. Nelson was 100% correct when he said this concept is more caught than taught. You have to experience it. Well, some people don't want to experience it with a really large number in their mind. So I tell our clients, if they're undecided, let's just tip your toe in the water and see how cold it is. And then we can actually add to the system along the way. And I'm confident that they're going to, if they follow the 5 tenets that Nelson set up, they are going to want additional policies down the road. And that happens all the time when we have clients calling back up, or we do our annual reviews and people say, oh, now I want to start another one, because they understand how the process works. It's just taking the banking function into their own hands. It's just using one financial institution and replacing it with another financial institution. That's all you're doing.
So as we wrap that idea up, we're going to talk about the ninth mistake, which is not getting started or not deciding. I think the challenge with anything that is so novel to our current way of thinking and operating, if it's something that you've never done, if you've never started an infinite banking policy for the first time, getting over that hump of beginning your first policy can take a lot of mental energy. It can take a lot of courage to do something new and something different that you've never tried before. And often when we're confronted with that level of change or transformation in our life, it can be easy to postpone that decision and say, I'm going to think about that later, or I'm going to come back to that, or we'll table that, we'll circle back to it next month or next year or 2 years from now. Maybe the financial circumstance will change. Maybe I'll feel differently about this. Maybe I'll just do more research. And the challenge with that is that you can put yourself in a vicious cycle of never having enough feeling of confidence to be able to move forward. And the real truth is that confidence doesn't come from lack of questions or lack of concern about something. It really comes from a position of saying, I've reviewed the facts. I understand what I'm doing. I understand the commitment I'm making. I'm going to jump in, even though I don't feel 100% comfortable with this. It's facing that hesitation or anticipation or even fear and choosing to act anyways, because when you do, you get so much benefit and you get the freedom and the feeling of satisfaction of knowing that you courageously adopted a new way of thinking. And so I would just encourage you, every single place that you get an advantage in your life, or you have something that really good happens to you, has been on the other side of that decision point, making a choice to get started.
Yeah, I used to worry about this a lot more than I do now, because I realize that the people that don't want to get started, they're never going to understand the concept, and they're not going to utilize it in the best of their ability. But I do, on a weekly basis, hear somebody say, I wish I heard about this a long time. I wish I would have started. That's different than the people that are continue to look for illustrations and the perfect situation. It's a person that has been introduced on the fringe of it that says, man, I wish I would have looked into this deeper because it makes perfect sense. And Nelson simply would say, as a forester, it's the best time to plant a tree was 70 years ago. Second best time to plant a tree is today.
Mm-hmm.
I tell people all the time, we make decisions based upon the information that we had at the time we're making the decision. So when you get more information, you make the decision and move forward.
Mm-hmm.
You don't want to say, I want more information before I move forward. So yeah, very good points.
I love thinking about this from your words that you use often, Bruce, is take small steps, but quality steps. So if you are feeling a little bit of intrepidation to get started with infinite banking, find a provider you trust. Let me re-say that. Find a provider that you trust. Find somebody that you know has your best interest at heart and is willing to walk on that journey with you. And then get started. You might start with a smaller policy than you originally thought. That gives you the opportunity to make it a journey and to continue adding policies in the future. But take that quality step and don't be that person who says 20 years from now, I wish I would have started 20 years ago. So we're going to leave it there. There's so much value in recognizing these mistakes, because when you can see these mistakes with infinite banking, they can serve as a warning light to you that says, turn back to the original intent, the original source. Get your capital working for you. Store it in a place that is going to do the most for you. And sitting it in the bank or under your mattress or in the safe is really not doing you the most good, because you're not growing it with uninterrupted compound growth, and you're not attaching a death benefit to it if you're doing it outside of infinite banking. So start using the concept to begin to make traction in your financial life. It was wonderful joining you on this episode today. Thank you, Rob, Brayton. Thank you, Fritz, for joining in the conversation and adding comments. If you want to apply these topics in your life and be able to start making traction in your financial life, and you want to take action with infinite banking, go over to themoneyadvantage.com, book a call with our advisors, and find out how you can get started with the right policy design, the right premium amount for you in your financial life, so you can start reaping the benefits. Thank you for being with us today. In closing, please remember, success leaves clues. So model the successful few, not the crowd, and build a life and business